when you invest in real estate, you're really looking at 3 to 4 key write-offs or benefits of real estate. The first one is appreciation. You can't count on appreciation. Appreciation is a gift. If you get it, great. The number 2 and the most powerful tax deduction on the planet is depreciation. So normally, if the big beautiful bill doesn't pass, you just simply take the property that you're buying and you figure out which portion is the land and which portion is the actual building, the improvement, right? And so let's just say you're buying a $400,000 property and you figure out $275,000 of it is the improvement. So you simply can divide that $275,000 by 27 and a half years. And every year you get to write that off on your taxes. Now, if you're a real estate professional or not, there's some rules around that. You got to talk to your CPA. But the cool thing is you can write that off on your taxes every single year. What the big beautiful bill does with 100% bonus depreciation, that's why so many people bought jets back in the day, because jet, you can depreciate it all year one. Same thing with real estate. So you can do what's called a cost segregation study. You can do it yourself or you can hire somebody to do it for you. It says of the $275,000, that is the improvement. How much of it is eligible? Do I break it off in the cost segregation? How much is eligible for the 100% immediate depreciation? And then how much do I have to leave in there for the next 27 and a half years? So what's really cool is most likely that 100K of it is immediately depreciated on that year's tax returns against your income. And you immediately get a $100,000 tax break for buying a real estate investment property this year. Like that's going to be huge. Like we expect our DSCR loans to quadruple if the big beautiful bill passes with 100% bonus depreciation. I mean, that benefit is just absolutely amazing and incredible, right? Of course, number 3 is cash flow, earning that cash flow every single month. And that cash flow continues to grow over time. And the 4th, of course, is the additional write-offs that you can write off on an investment property that you can't write off on a primary residence. So like, for example, you can't write off a certain amount of the taxes and insurance. There's caps in different cities and states. You can't write off HOA fees. You can't write off what I call TIMR. So we can put a little acronym together. So taxes, insurance, management, maintenance, utilities, repairs, TIMR. You can do all of that with investment property and you can't with a primary residence. So if I'm paying a property manager 6, 7, 8% to manage the property, I can write that off. Long-term rental. If it's a short-term rental, I might be paying 15, 25, 35% to have somebody manage that short-term rental for me. So there's so many write-offs. So those are really the 4 key things, the 4 benefits of investing in real estate.